Waseem Thokan, economist at Legae Securities, is now joining me as we wait for the South African retail sales numbers to be released. In the meantime, we had CPI numbers coming out today, a 6.1% year-on-year rise for December in the inflation rate. That takes the 2011 inflation rate to 5%. So still below that target range, Waseem, of 3 to 6% of the Reserve Bank. But the December inflation rate just sitting a shade above that target band. Give us an idea of where the key pressure points are for you right now in terms of the inflation number.
Hi, Samantha. Thanks for having me. First of all, I think the inflation rate, the pause in it in the most recent data is quite an encouraging sign, but we don't expect it to be very long lasting. Our base case view is that the structural factors that underpin the higher inflation in South Africa are still in place. Those are mainly out of the food and non-alcoholic beverages price inflation, as well as petrol price inflation. You saw food price inflation actually tick up to 11.1% in today's reading. And although petrol price,
that is a surging inflation there on that front. Is that going to persist for the foreseeable future?
At least for the first half of the year, we still see some considerable upside to the outlook on food inflation. That'll be supported somewhat by the weakness that we saw in the rand coming out of the fourth quarter of 2011. And that hasn't really fully worked its way out of the numbers. And as a result of that, you'll see inflation drifting up quite steadily during the first half of the year, especially.
Before we get into overall inflation outlooks and interest rate outlook going forward, we just had those retail sales numbers coming through for November, 6.8% year-on-year rise, and that's below the consensus forecast. Now, we've generally seen an upward trend and surprising numbers from the retail sector. What was your forecast for these numbers?
We forecasted that retail sales would be up just under 7.5%.
So this is, substantially below your forecast.
Absolutely, this is a little bit of a disappointing number. Obviously, given that it's just come out now, we haven't had a chance to dig down into the numbers. Previous numbers have indicated that, especially in the durable goods sectors of the retail component, there's been some upward momentum. I mean, you saw retail sales in hardware, paint and glass in the last reading before this one growing at 20% plus. That was always not gonna be, that could never be a sustainable level of growth. And given that wage settlements are still moderating in the South African economy and unemployment still remains high, and household debt itself is still at an elevated level, really. It was always likely that there would be some softening.
Yeah, likely that there'd be some softening, but for the most part, it really has surprised to the upside. Why have we seen consumers? I mean, would you say right now that consumers are biting into their discretionary income or taking out debt really to fund discretionary purchases or purchases that are perhaps not priority right now, given all the concerns that we have around the growth story, as well as the pressure that people are facing in South Africa with regards to debt?
Samantha, remember that there'll be a part of that in the numbers, but given that the consumer environment has been mainly supported through the durable goods component, a lot of that would have been replacement demand. So, consumers replacing durable goods that they had.
And those purchases which they hadn't made for some time, of course, we had the recession really cutting back into those purchases.
Absolutely. We saw actually quite a muted outlook on non-durable goods as well as services. That indicates that the consumer is probably actually paring down on spending on those or buying down into into those components to support the durable goods demand.
Let's focus forward onto the MPC taking place later this week. Interest rates, of course, have that lag effect. So any outlook for inflation really needs to have that 6-month projection and outwards from there, because that's really what the Reserve Bank will be looking at. It's hard to tell. There's lack of visibility right now in terms of what the global story is, in terms of inflation, in terms of what's taking place in Europe. But 6 months and there on out, what are your thoughts in terms of where we're going to be sitting on the inflation side of things in South Africa?
Our viewpoint on inflation is slightly ahead of the market consensus. We believe that inflation will peak around the third quarter of 2011 at around 7%. That's slightly above where the market thinks it's going to be. Again, we believe that one of the major contributing factors to that will be the weakening of the rand, and something that's going to be significant in that regard is that because global demand has come off slightly, yet the domestic consumer remains somewhat in a somewhat confident mood. We feel, and the domestic corporate sector, the profits seem to be reasonably good. We feel that there's a significant chance of a widening in the current account deficit. On that basis, the rand should actually drift lower in the first quarter of 2012, and that could have deteriorating consequences for inflation.